Hello traders, Thierry Narpan here, founder of Master the Markets, Elite Traders Conference and the Traders Open Day. So today we're going to be looking at this topic called risk management using lots. Okay, so most of you are very familiar if actually you've been trading for about 2-3 months, or if you're complete beginners. Sometimes you would have come across risk management using your standard position sizing formula, right? So for example, you want to look at your stake size, which is like pounds a pip, especially used in spread betting. It's like we use this general formula, right? So we look at it, let's look at this equation. We use this general formula called position size, or we can say stake size as well, right? Stake size. And then we are looking at this general formula where you're looking at an account risk, right? So let's say, for example, your account, you've got 10,000 pounds in your account, and then you're looking at a 1% risk management, right? So that would be basically 1% of a 10K account, and that would basically equate to £100, and then divide that by your trade risk. So let's say your trade risk in this example here, let's say was just 100 pips, right? And that would then equate to, let me just erase that away. Okay, let me just quickly do that again. So £100 divided by 100 pips is what we're looking at. That's your trade risk over here is what I'm looking at. So that's your entry minus your stop loss. And then after that, you will get a position size like this, okay? £1 a pip. Or you can also call this as your stake size. And that's what you would enter basically into spread betting broker position size point, right? Where they ask you for the stake size point or whatever. So that's what you enter into £1 a pip. Now, traders, you would have seen this formula almost like everywhere around the internet. Now, some of you may be asking, okay, but what if I'm using a direct market access broker, right? So when you're directly in the market and you're trading with other buyers and sellers, because in the spread betting area, you're actually trading with the broker himself. When you do not do that, when you're actually getting into the market itself and you're buying it on leverage, usually we don't use stake size, right? So what we usually use at that point is what we call lot sizes. Yeah, so some of you may have heard, or maybe new terms to you, one lot, one micro lot, one mini lot, right? So what we are really looking at here is how to convert this position size that you've got, stake size, into lot basis, right? So I'm going to take you through that. It's quite a bit of a process, but I'll break it down step by step so that you can really understand it really well, right? So the first one, what we need to be looking at, so from here, which is a generic equation, which is the position size, we're going to now break it down into a lot based equation, right? Now, before I carry on to the next point, I do want to tell you that you first need to remember this point, right? So the first point what you need to remember is one lot is equal to 100,000 units. Yeah, 100,000 units. So some of you are asking, oh, hang on a minute, Thierry, what do you mean by units? Okay, this is what I'm going to explain now. This is the second point that you got to understand. Now, in this over here, in the second point of the units, what I want to say is that, let's say for example, right, let me take your mind out of the market for a bit, right? So let's say you went to go and buy a bunch of let's say apples, right? A bag of apples. Let's say in the bag of apples over there, you bought, let's say, one apple, right? For, let's say, what should we say? So maybe, let's say, maybe 90 pence, right? So one apple for 90 pence, let's say you bought it for. And then you, let's say, then you held on to it. Let's say the price of the apple fluctuates and then it rises up to, let's say, £1.20. Right? £1.20. So over here, if you just bought one apple and once it's risen to £1.20, you've made a profit. Really easy over here. Simple calculation over here. It's just 30 pence, right? So you've just earned about 30 pence profit, right? Profit. Okay. And of course, this can be dollars, and it can be 30 cents or whatever it is not, right? So 30 pence profit you have earned for one apple. Now, think about this. If I bought one apple, I just made 30 pence profit. But if I bought 100 apples, right? If I bought 100 apples, now how much would that be? For 10 apples, it would be £3. So for 100 apples, it will be £30, right? And then if you carry on with that, then 1,000 apples will then give me basically £300. Now we can carry on so forth and on, right? So now based on that basis, what I want to bring your attention to is we're going to apply all these concepts back into the market right now, right? It's the same concept. So now let's replace the apple by 1 unit. So now let's see traders, right? So for example, let's say we're looking at cable, let's say GBP USD, right? So if you're looking at GBP USD and you're looking at, let's say, a price of 132.50, right? So at this point of 132.50, what we are looking at over here is the smallest increment. So for example, in our normal transactions that we do, the smallest increment that can happen is 0.01, right? Or also known as a pence, 1 penny, right? But in the Forex market, the smallest increment that can happen is basically 0.0001, or also known as a pip, right? You all are familiar with that. Now, in that instance over there, so in a pip is what we call the smallest increment, and usually when we buy, just like in the outside market, just 1 apple, when we buy cable, the smallest number of units that you can buy is 1 unit, okay? So 1 unit you can buy of cable at 132.50. Just like that, 1 apple for 90 pence, you can buy 1 unit of cable for 132.50. Now, since the smallest price increment that you can do is 0.0001, so every time it moves by 1 pip, the profit that you can make very easily is 0.0001, right? And you might be asking, okay, what's the currency unit? Because this is the code over here, which is the US dollar, so all this will be also in US dollar, right? So, now let me reiterate this once again, right? So let me rub this away now, and let me just put this all over here so that it makes sense, because it's got to be done systematically and methodologically, right? Or else it won't make sense, okay? Right, so I'm just going to write this over here right now. So what we're looking at is 1 unit, right? 1 unit of cable. If you bought it and it rises up by 1 pip, the profit that you're going to make is 0.0001 US dollars, right? Because it's always in the quote, okay? Whatever that the currency fluctuation is happening on. Right, okay, so far that's good. So just like 1 apple, you bought it, and if it rises up by 1 pip, rises up by 30 pence, you're making 30 pence profit. In this instance, it's risen up by 1 pip, you're making 0.0001 US dollars. So let's go on, right? So if I bought 10 units, right? If I bought 10 units of cable, right? That would give you 0.001 US dollars, right? So you can keep on going on forth like this. So now, one standard lot is 100,000 units, right? 100,000 units. And when you do the calculations, 100,000 units times this, then you will get $10 a pip, 10 US dollars a pip, okay? 10 US dollars a pip. That means all I'm saying is that you've bought 1 unit of cable, you've bought just cable alone, okay? You've bought just cable alone, but if you bought 100,000 units of it, every time it just moves by 1 pip alone, you're making $10. It's like saying, you bought that 1 apple, right? And every time it just moved by 30 pence, you're making 30 pence profit. But if you bought, let's say, 1,000 of them, then you'll be making £300, right? So that's what we're saying. So it's the quantity that is exemplifying the profit that you are making, all right? So that's the second point that we need to know in terms of formulating the equation for the lots-based risk management to convert this into per lots, right? So let me go on further. All right, so we understand this. So every time, if you bought 100,000 units or 1 lot, right, or 1 lot, that would be $10 a pip. Now, the other kind of measurements you would have heard is basically 10,000 units, right? 10,000 units is 1 mini lot, and then of course if you're going below that, then it's 1,000 units. Now, so 10,000 units would be, let me just write that down. So this would be a standard lot, right? So and 10,000 units would be basically a mini lot. and 1000 units would be a micro lot, right? So in terms of 10,000 units, that will equate to usually $1 a pip. Basically, all I'm doing is 10,000 times this amount here, 0.0001 US dollars. And over here, it will be basically 10 cents a pip, right? 10 cents a pip. Basically, it's 1,000 times this amount over here, right? So just 10 cents a pip what we're looking at, and then after that, it just rises up by like that. So that's a mini, micro, and that's a standard lot. So now we got all that clear right now, right? So now we move on to the third one. Now the third one is what we call the currency conversion. So all we're doing in this step-by-step methodological equation over here, turning this £1 a pip into asking myself, if I want to make £1 a pip all the time, how much units do I need to buy? So I'm working backwards. So it's like saying, you know, I want to make £30 profit from the apple example that I gave you. And if each apple is only giving me 30 cents a profit, how many apples do I need to buy? So I'm going backwards. Understand that? So 30 pounds divided by, let's say, 30 cents. And then we are looking at about 100 apples that I need to buy to make the 30 pounds profit. So this is what we're doing over here. So I'm asking myself, if I need to make £1 a pip profit, that means every time it moves by 1 pip, if I need to make £1, then how many units do I need to buy and then convert that back into lots is what we're looking at, okay? So this is why we had to break it all down over here. But you do know if you only just bought 1 unit, you only make this amount of profit. And if you bought this amount of units, then every time it moves by a pip, you're making $10. Now, let's go back to this one again, right? So we want to make £1 a pip. So the last part of the equation is you need to convert this because there's a currency difference here, right? Traders, if you look, there's a pound sign here and then there's a dollar sign here. So the last point what you need to do is then convert the pound, £1 into US dollars, right? US dollars, okay? And then in that equation over there, if you know that is 1.3250, let's say 13250 US dollars, if let's say that is the current currency conversion point, then from that point onwards, then what you then do, so basically I'm looking at 13250 per pip, right? 13250 per pip. So based on that, then I can then convert it then back to the lots. Okay, you got that? So basically what we're then saying is that if $10 a pip is 100,000 units, then how much will 13250 US dollars be in terms of units? So I'm just working backwards basically. Got it? So it would just be a little bit more than 10,000 units, because on this equation here, because you saw that $1 a pip is 10,000 units, so if $1.3250 would be about something like 13,250 units. Okay, so that's what we're looking at. So in terms of the broker, then if you want to convert that back into lots, then what we are then saying is that 10,000 units is 1 mini lot. So then after that, 13,250 units finally would be basically 0.13 lots, yeah, 0.13 lots, and that would be your answer over there in terms of converting that. Okay, now so that's the whole understanding of that. So all you're saying is that if I buy 0.13 lots, that's like good as buying 13,000 units, and every time that it moves up by 1 pip, you'll be almost approximately equating £1 a pip. That's how you convert it back, traders. Hopefully that makes you just understand and appreciate how the lot sizes works and the units and how the whole market actually moves as a whole dynamic fashion, right? The final thing I do want to mention is that do not worry about just equating and calculating this every single time. I only did all this just to improve your understanding of how actually the market functions, right? And how the buyers and sellers actually interact on the ground level. All these kind of equations, you can just simply put it into a calculator online. So basically that's a position size calculator that you can use. Just Google it. And then once you find it, you just need to put in like a few entry points that we ask, like for example, your entry, your stop loss, your trade risk and all that kind of stuff that we just did over here. Your account risk, how much you want to risk and all that. And finally, they will also ask for like which currency you're doing that for, so that they can then find out whether they need to convert it back into the account currency that you have, right? The currency must always be converted into your account currency. Your account currency is basically what currency is your current account in which you're trading on. Okay, So do not worry too much about the calculations. I mean, you can always go on a position size calculator, but definitely do go and understand what this is all about, because it will give you such a more integrated understanding of the markets. Okay, I believe this has been really, really good, massive value for you. And until the next time, as we always say, stay disciplined, follow your trading plan, and keep trading like a master.